Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Hello, I'm Mike Kell, Senior Vice President, Program Management and Business Development here at AI Insight, and I'm joined by my counterpart, Laura Sexton, Senior Director, Program Management, to discuss our most recent private placement industry report for September of 2020. Kind of an interesting September. It was we had a blowout Q1. Q2 was subpar to say the least. Q3 was interesting, and September actually was was a record month for us, and now with September being such a blowout month for us here from adding new entries and increasing our coverage perspective, we're actually up 5% year over year, which is very exciting, knowing what we've gone through with COVID. So we're cautiously optimistic. Q4 is typically higher volume for us in relation to all the other quarters throughout the year. A lot of that, I think, will be dependent on the conservation programs. Typically, we see those in Q4 and more toward even November and December timeframe. So it'll be interesting to see what comes to play there. That will certainly impact us. COVID certainly is still in the news and very much impacts our daily lives. So we'll see how that impacts the market here as we close out the year. And then obviously the election in November. I think we can all relate that there's a lot of unknown there, depending on what channel you listen to or watch or whatever that might be. All kinds of different talking points, but either way, we'll kind of see what the impact is there. But here at AI Insight, we're very excited about Q4, and hopefully September really sets us up for a strong Q4. So with that, I'm going to hand it over to Laura. Laura, give us a little bit of what we're seeing in the overall private placement coverage to include any trends year to date and anything in particular for the month of September.
Yeah, sure. Yeah, I mean, like you said, it was definitely a strong September after several slow months. So we had 19 new funds added to the funds that we cover in September, which really was led by 1031s, energy, and then the non-1031 real estate sector. So that brings our total coverage as of October 1st to 177 private placements with an aggregate target raise of $17.1 billion. And an aggregate reported raise for those funds raising capital of $8.4 billion, or about 49% of target for those that are currently raising. So in terms of our coverage, I mean, we definitely are kind of led by real estate. Any of the real estate funds, opportunity zones, 1031s, non-1031s, LLCs, and LPs represent about 72% of the funds that we cover, and about 60% of target raise. We cover private equity and debt funds. Slightly smaller amount, 9% of the number of funds, but those tend to be bigger, so they represent about 27% of our aggregate target raise. So we certainly watch the market there. And in terms of our coverage by objective, income, certainly the largest amount at 52% of the funds, growth and income about 29% and 18%. And that's really kind of stayed similar over the last couple of years. I would say, 11 private placement funds closed in September. We had a lot of 1031s closed during this time period. So all either met or exceeded their target raise in the month of September, which is good. So 120 funds have closed their offerings year to date. But when I say close, I mean they've closed their initial offering. And so 120 funds, private placement funds, have closed year to date. Those funds were on the market for an average of 330 days, and they reported that they raised 62% of their target on average. So, the trend in September was to meet or exceed. Through the year, they've raised about 62% of their target. And we have seen 7 private placements that suspended their offerings and 1 terminated just due to uncertainties related to COVID-19. And I think, some of the main trends, I mean, energy definitely has picked up The 1031 segment has definitely picked up. Those two are, leading the private placement market right now. We haven't seen a lot of activity in energy over the last couple of years. So that's definitely interesting to see. Preferred funds, another area where we've seen kind of a big pickup. It's a 5% increase year over year in terms of the number of new funds that we've added. And I think interesting there with preferred, and we do cover public preferred, but the private preferred market, I think this year, maybe getting a little bit of a bump, likely kind of due to companies searching for alternate ways to finance projects, and then investors looking for ways to invest in areas that are kind of properly priced. And so, interestingly, talking about preferreds, we had a webinar recently with one of our sponsors, Time Equities, and interestingly, they're a long-term, opportunistic value-add real estate investor. But they said, and this is kind of consistent with what we're hearing, is that the United States real estate market really has not repriced yet. So it hasn't baked in, the long-term impact of COVID and this downturn. And so, investors right now kind of, trying to allocate some capital as safe as they can, preferred maybe some mezzanine debt on properties that they would like to own. That's where they're finding the opportunity. So, all kind of seems aligned. We've seen an increase in the number of private preferred funds. We're hearing from our sponsors that there are some opportunities there. So kind of, interesting to see from both sides on the preferred side. A couple of market trends that I wanted to highlight, that I think might have kind of longer term implications on the private placement market. One of them that I think is really interesting is, not directly related to private placements, but it could be, reading about the increased percentage of passive investment in public REITs, which is actually driving further investment into private real estate markets. So there's a recent article by Jones Lang LaSalle that said that passive real estate funds used to be about 20 to 30% of traded REIT investments, so the index investing in the REITs, but now it's 51%. So what that means, fewer active funds investing means fewer potential backers for an IPO, because the passive funds will only invest in REITs when they're listed, of course. So it's one of the reasons why we've had very few public REIT IPOs. And it also, means that owners of real estate portfolios are actually looking at other options for liquidity to realize value. And that includes private market portfolio sales, maybe sales to private funds, private market recapitalizations. And the article also says that because of this kind of index investing, it also means that the public REITs have had a higher correlation than they had before to the public markets. And so in order to really diversify, they don't provide the diversity that they used to in a portfolio. So from a portfolio standpoint, it may make more sense for investors to look at non-traded or private real estate. So I think, that bodes well, I think, for both the non-traded and the private placement real estate markets overall. I just think it's an interesting trend that we could see kind of have that, isn't related at all to COVID, but could have pretty broad long-term implications for the market. So those are some of the main trends. One note on energy too that I think is interesting. You've seen a lot of companies kind of coming back into the market in energy. I think there's, been a massive repricing since 2014, really, but this kind of, this downturn especially has been interesting and difficult. But it has kind of set there's a few things going on. One is kind of set the expectation that oil and gas is going to trade within a lower range. And so, investors and oil and gas companies are resetting their expectations. They're, cutting their costs as they need to, just to kind of world of lower pricing in oil and gas. So you've had some of that. And then you've also, what's also interesting about the kind of lower range for oil and gas is that it's actually made the returns for renewable projects more attractive. So it's more consistent. It used to be that, investment in an oil and gas project was going to yield higher returns than renewables. Now, investment in renewables is, kind of more on par with an investment in oil and gas. So it makes the renewable side a little more attractive. So you're actually seeing more traditional energy companies actually investing more in renewables, because even for them, the returns on those investments are, kind of just about on par with their own investments in fossil fuels and traditional energy sources. So we have seen that here too. Some of our larger sponsors that we have a renewable component. So it's pretty consistent across the board. And I just think it's interesting, probably a good trend overall, I guess, for the, kind of the environment and, the focus on renewables. But, interesting to see that it used to be that people would get interested in renewables when oil prices went up. But now, with this kind of lower range bound environment we're in, it actually has helped kind of spur investment more, just because of the attractiveness of the returns relative to traditional fossil fuels. So those are a few of the things that we're seeing here on the private placement side.
Hey, thanks, Laura. And as always, I think we have an interesting visibility into a lot of these different investment programs that are in the retail space, just by the nature of what we do. So we certainly appreciate being able to provide some of this context in trying to tie it to the higher financial markets as well, to provide a little bit more insight. Quick reminder, industry reports, it's available within the AI Insight platform for those of you who subscribe. A lot more comprehensive information there. We provide this information in the private placement market on a monthly basis. So with that, we'll wrap it up for now, and we'll look forward to talking again next month. Take care.